Hi everyone, I'm Zach Palmer, Certified Financial Planner with Ark Royal Wealth Management. Today we're breaking down the difference between two terms that confuse a lot of people: marginal tax rate and effective tax rate. They sound similar, but they're actually very different, and understanding the difference can help you make smarter financial decisions and avoid common misconceptions. Let's get into it. The United States has a progressive tax system, which means your income is taxed in layers. And that's exactly where these two terms come in. This is the rate you pay on your next dollar of income, not all of your income. On the left is the 2025 tax brackets for a single filer, and the right is for married filing jointly taxpayers. Let's say Rob, a single filer, makes $150,000 a year. That doesn't mean all of it is taxed at 24%. Instead, chunks of it fall in different brackets. So his marginal tax rate is 24%, because that's the rate that applies to your last dollar earned. But here's something a lot of people miss. Your tax rate isn't calculated off your full $150,000 salary. It's based on something called your taxable income, which is less than your gross income or adjusted gross income. So what's the difference? Well, adjusted gross income, or AGI for short, is your income derived from all sources: wages, investment income, taxable retirement accounts, minus certain adjustments found on Schedule 1. Taxable income is what's left after the standard deduction or itemized deductions are subtracted. And tax brackets apply to your taxable income, not your AGI. Now this is where most people get tripped up. Your effective tax rate is the average tax rate you pay on all of your income. Let's do the math together and go back to Rob, who makes $150,000 and takes the standard deduction for 2025, which is $15,000. That brings his total taxable income down to $135,000. Now let's walk through the tax brackets. He pays $1,193 at the 10% bracket, $4,386 at the 12% bracket, $12,073 at the 22% bracket, and the remaining $7,596 at the 24% bracket, for a total federal tax of $25,247. We get the effective tax rate by dividing $25,247 by $135,000, which equates to 18.7%. So even though Rob's marginal tax rate is 24% and his taxable income is $135,000, his effective tax rate is only about 19%. This is why understanding the difference between gross income, AGI, and taxable income is so important. It changes how much tax you actually pay. Just to recap, marginal tax rate 24%, which is the tax rate on the next dollar. Effective tax rate is 19%, his total tax as a percentage of taxable income. Why it matters? Well, your marginal tax rate helps you with planning, while your effective tax rate gives you the big picture. If you found this video to be helpful, be sure to like and subscribe for more insights on building a strong financial future. Thanks for watching, and I'll see you next time.
If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.